Hello. Looks like I'm live. As usual, looks like I have Frantic Pillow and Shoeless Joe here. All right, guys. So I made this thumbnail for this live stream pretty much as soon as I woke up this morning, and and basically because I knew it was going to be a bad day. As soon as I woke up, I saw the market was down, and I saw Target's results. I knew that the day was going to be bad, so I made this thumbnail. What you guys are getting right now is pretty much my live reaction to the market. I'm gonna need, how do I share that screen before I look at it? Here we go. Well, I see red. So wow, just gonna take a look at okay, that sucks. Man, that is terrible. Okay, so I am taking a look right now at Yahoo Finance. Looks like the market just closed right now as I'm getting on. It is down 1,190 points, down 3.64%. The Nasdaq down 4.73%, pretty much wiping out the gains of the last couple of days. Nasdaq or Russell 2000 down 3.66%, and crude oil is down $3.11. So a couple of reasons behind why crude oil might be down. I think the anticipation of perhaps decreased oil usage is there. It's just a general reshuffling of money, people getting out of the market as well. But the big thing to talk about here is really going to be Target's earnings. And let's see, I'm just going to Google Target News here, and we'll talk about what comes up. I did read a little bit about their earnings earlier here, but just go to Barron's. I have a subscription here for them. But I think the main takeaway here is that Walmart and Target had substantially similar results. All right. So Target followed suit by dropping 26% after results today, also tracking its biggest drop since 1987. You know, I haven't talked about 1987 much before in terms of how that worked with the market. It was 1987 was a very interesting turnaround where if the market was down basically 50%, or not 50%, I don't remember what it was down in 1987, but it was considered a disaster. It was down a huge percentage just in a matter of hours. And and one of the most interesting statistics too is that 50% of financial advisors that were actively licensed in 1987, by the end of the year, 50% of them had left the business permanently because of what had gone on at the time. But if you were someone like a Warren Buffett, where you didn't make any changes at all in response to the 1987 crash, by the end of the year alone, he was back up. He had not lost any money by the end of the year simply by holding on to his investments. So, so very interesting about what's going on with Walmart and what's going on with Target. So beyond the numbers, there were ominous signs for the state of the consumer and how pocketbooks are being squeezed. There is the shift towards spending, in services. Target said shoppers were refocusing purchases away from larger physical items like appliances and televisions. This is a pretty bad sign for manufacturing. And they were spending money towards going out experiences such as restaurants and gift cards. It could mean consumers have already pulled forward much of their spending on electronics and home goods and furniture because of the pandemic. And most of those items don't need to be upgraded or replaced for years. So that's not necessarily a bad sign for the economy overall, particularly if you work in the service industry or own a bar like I do. That's definitely not bad. But yeah, so a lot of things going on. So I'm really looking forward to seeing Amazon's I don't know if I'm looking forward to seeing Amazon's results or not, right? So that could be fairly interesting. But what we saw was declining. What we saw with Target was the fact that Target was down by 24% in this time period. And it's down because their earnings per share came in pretty far under what was estimated, right? And when I say that though, they're okay, I'm going to get on Mark Butler. I'm going to talk about your comments here in just a minute. So you kind of distracted me with that comment. I do want to address that later on, Mark Butler. But okay, so what was happening with Target is that their earnings per share suffered, but revenues actually look pretty good and increased year over year. What is increasing for Target is the cost of doing business, meaning everything that involves their supply chain has suffered at this point. And we've seen, like they said, that shift from buying services like gift cards from Walmart and from Target, and and shifting the consumer spending towards services. That is really kind of hurting their bottom line at this point. But it was really supply chain effects and the increased cost of doing business, like increased shipping cost, increased product cost. All that was really dragging down their returns in this time period. So, all in all, though, this might actually provide a pretty attractive entry point for Target. If I'm looking at price to earnings ratio at this point right now, it looks like they're at 11.39. That's an extremely good price to earnings ratio. A dividend yield of 2.25%. I think it's time for us to start talking about dividends again. It's something that really hasn't been all that popular for the last couple of years, but a dividend of 2.25% is actually historically pretty low. But in terms of what the rest of the S&P 500 is doing, it's actually not bad at all. Short interest is pretty low. It's about 2% of the float right now. And beta, meaning the measure of volatility against the rest of the market, actually looks pretty good at this point. But none of the peers are down. We had Costco sales, Walmart sales, all Costco results, Walmart, or we haven't had Costco results yet. I would expect Costco results to significantly mirror what we saw from Walmart and Target, which is we're not seeing a decline in consumer activity. We're seeing a shift to consumer activity, and we're seeing higher expenses for businesses. I don't really, I expect Best Buy to actually really suffer in this respect. So, yeah. Anyway, did you guys catch my video that I did earlier today? I haven't done like a regular video in quite some time, but I did that on the electric bikes that are being used in Ukraine by fire teams that are carrying in-laws, and I think it's pretty interesting. So I'm going to go through, check that video out if you get a chance. It was just kind of an interesting video that shows how much further along we are in this electric revolution than we may have anticipated. And the Ukrainian military isn't the only one that is actively using or experimenting with e-bikes, in the field. So I just want to say hi to a few people. Frantic Pillow, want to say hi. You're a legend. I really think you should create a social media account, preferably Instagram. I think you could grow really fast since you're posting quality content. Well, thank you so much. I really don't understand why I haven't grown so much. Maybe I do. I don't know. Maybe I'm not good looking enough. I don't know. Maybe I'm boring. I don't know. But I try to give you guys clear and unbiased opinions, content, and facts. And I'm not trying to sell you guys anything. One of these days, I'll do a sponsorship video. The only people that have offered me sponsorship so far have been people that I'm not going to put my name behind or have been not related to the channel at all. So, so thank you so much for posting. Your comment actually got texted to me about a half an hour before I went on by one of my friends who saw that and also said the same thing. I need to do that. So, so here we go. This is a good comment. Elon Ozolin says, as McDonald's is leaving Russia, looks like for good, what happened with all the restaurant equipment and everything else? What stops Russia from using the brand name in the receipts? So they probably can't use the brand name, but they may be able to. And there's a couple of reasons why. There are actually some giant franchisees, and I'm thinking really like Arcos Dorados in South America. They essentially bought the rights to use the brand name, the restaurant equipment, all that stuff, and they've been expanding for years in Brazil for the most part, but all over Latin America. And they operate sort of semi-independently, and they're actually a separately traded company. I believe that their ADR is still traded on the New York Stock Exchange. I haven't paid attention to them for a while. There's another one of those Motley Fool picks that I dove headlong into and lost a bunch of money in, but it was Arcos Dorados, like golden arches in Spanish. So it could function like that. You could basically, they do have a buyer for their properties and for their restaurant equipment. And I don't know if you knew this or not, but due to a couple of different reasons, Russia, and this is the strangest thing, Russia produces lots of potatoes, right? But for a very, very long time, the variety of potatoes that they needed to produce really good French fries were actually imported from outside of Russia. And I don't know if that's one of the things. I don't think that we're actually slapping sanctions on food exports to Russia right now, but that's one of the things that could be changed. So They may be using the McDonald's franchise name. It may be something else, but a company is stepping forward to buy the company. So, and all right, let's move on here to another question. And watched last night's stream on Catch Up. When you said Upstart is more limited than SoFi, did you mean in future growth or revenue potential, or just the range of services they offer? I just mean the range of services that they offer. So here's how they could be a lot less limited and rather quickly. They're a profitable company. They are their balance sheet looks very good. If they were if they were to go back to the secondary market or to the stock market and make a secondary offering right now, I don't think it would fare all that well. But I think they could do very, very well by offering convertible securities to raise $1 billion here or $1 billion there in order to go out and acquire businesses that they want to develop, much like SoFi has done. If they're going to use, and I think the safest way to do that probably right now for investors is going to be with those convertible bonds. So I actually expect that we are going to see Upstart go through a period of acquisition this year. They're going into this possible recession. They are looking pretty good in terms of their financial stability, and there not a lot of companies can actually see that at this point. So let me see. Patrick Mulligan says, hi, all. Thank you so much, Patrick Mulligan. Did want to remind everyone that the super chat features are on. If you are so inclined, I would really appreciate that. We see here. Recession soon. If so, will the market go down another 30%? So there's a couple of different arguments. We had, if I recall, they revised numbers for first quarter of 2022. We could, and GDP declined by 1.3% in that time period, mostly blamed on supply chain issues. So we could already be in the middle of a recession. A recession is just defined as 3 consecutive quarters of declining GDP. And we're probably, I think it's almost a certainty that the second quarter we're also going to have declining GDP. So we could actually already be in the middle of a recession. Now, remember that there are no guarantees. No one's got a crystal ball. But the stock market is that forward pricing mechanism for the economy. Like we're pricing in what we think the economy is going to be like in the future here. So I think that recession fears started way back in November and December, and some of that has already been priced in. And as soon as we had the dreaded inflation conversations, a lot of that started being priced in. Like right now, I think that the market has pretty much priced in balance sheet roll off for the Fed and quarter point raises every month for the rest of the year. And I think that's pretty much priced in. If the Fed, and I think the Fed's recent statements may have caused the market to price in even more in the way of the next interest rate raise. We may see like another 50 basis points. But the balance sheet roll off is another thing that's going to help keep interest rates high. Keep a close eye on what interest rates look like on the long end. And if you don't want to go through and look at like 30-year treasuries or anything like that, something that's maybe a little bit more immediate to you in your needs is take a look at the housing market. And I think I mentioned this yesterday. I was at a barbecue over the weekend and had a discussion with the wife of a good friend of mine. And she was telling me that they have not had a single application for a refinance since the beginning of April, which that's not good news, folks. They're still seeing business right now in terms of sales. But even in that case, I'm looking at the housing market cooling. It's already cooling in a bunch of places. But here's 2 takeaways from real estate earnings here. Several housing metrics due this week are expected to show signs of a slowdown. Affordability has grown in importance as prices keep rising and mortgage rates have climbed to the highest point in a decade. The average rate on a 30-year fixed mortgage has increased more than 2 percentage points since this last reading in 2021 to 5.3% last week, and that's according to Freddie Mac data. That's the highest it's been since the summer of 2009. Okay, which is that's been a very, very long time. Affordability is slightly above its long-term average, which once again, you hear this all the time when you're a real estate investor that all real estate is local. Affordability where I live is completely been thrown out of the window with the interest rates rising 5.3%. You're looking at basically the cost to own a home on a monthly basis is about 30% higher than it was just a few months ago. So I am not very hopeful about the the real estate market here in the very near future being heavily impacted by interest rates. I think that right now the lack of inventory is keeping prices pretty high right now. But I think that the lack of inventory is actually not going to be as big of a factor here going forward, as so many people are going to be priced out of the market by interest rates going to 6.5% for a 30-year mortgage. Now, a lot of you folks listening to me right now aren't old enough to remember high interest rates. All right. So my first mortgage was for like 9.25 or 9.75. I don't remember exactly what it was, but it was a lot. It was a lot. And it was a shock then to realize that I bought a home for $100,000 and almost everything that I was paying at that point was interest. So yeah, so investors will get the latest indication of how rising prices and mortgage rates have affected demand this week. April housing starts and permits are two gauges of new home construction released by the Census Bureau and the Department of Housing and Urban Development. And we expect those on Wednesday. Wait a minute, is that today? On Thursday, the National Association of Realtors will release last month's existing home sales data. All of the metrics due this week are expected to slump on a seasonally adjusted basis compared to the prior month. Consensus estimate tracked by FactSet expect April permits to fall to a seasonally adjusted annual rate of 1.8 million, down from 1.87 million in March, while housing starts are expected to be 1.77 million in April, down from about 1.79 million on the month prior. So I don't expect this to be a giant decline. I mean, this is definitely not a giant decline, but it's an indication of things to come before. Existing home sales are forecast to fall to a seasonally adjusted annual rate of 5.6 million, down from 5.77 million in March. A lot of that is caused by the fact that a lot of folks in houses now have 30-year interest rates, anywhere from 3.5, 2.75 to 3.5%, 3.75%. Why would you exchange that for a mortgage today at 5.3% unless you're forced to move because you're relocating for travel or something like that? So, and a spate of recent earnings released from real estate technology companies like Redfin, Opendoor, and Zillow, all these have gotten absolutely smacked. Now, Zillow probably didn't get smacked as much because they've already gotten smacked down over the last couple of months, and but they're actually showing that their earnings are actually strained here. The market is cooling. The housing market remained hot throughout most of the pandemic, with demand to buy a home largely outstripping limited supply. Now, as home affordability concerns take center stage, companies said they expect the market to become less frenzied. Living where I do in Southern California, people are hyper focused on real estate just because it makes up such a large portion of their overall net worth. And owning a home is kind of seen as seen you've made it and you're wealthy. I realize that's not the case in all parts of the country. Like, owning your own home is just something you do once you have your first real job in a lot of parts of the country. But in more expensive markets, you buy a starter home, you work your way up. It takes years to save up that $100,000, $200,000 down payment. It's just a much bigger deal and occupies a much larger space in the minds of investors, right? And consequently, this is shown when you talk to people in the real estate industry here. Their sense of importance and the optimism when it comes to the market is really, really inflated. And I read this fascinating statistic that something like 79% of realtors in the last real estate downturn in the San Diego County, 79% of them had a home that was foreclosed on, right? And that's one of the things that I found absolutely fascinating, that they were not able to, and it's not the same as being like a stock market investor, right? It's not the same as saying, oh, well, you should know the stock market, be able to get out of the market. This is not the same. They borrowed money to buy a house that couldn't cash flow, meaning they couldn't rent it out to at least cover their payments, and didn't anticipate that a downturn in the market would mean that they would not be able to dispose of that home for a reasonable price for years and years and years. So the housing market is cooling. How bad it's going to get is anyone's guess, according to this article. Once again, I'm seeing a lot of realtors, and this is just anecdotal observations on my part. I'm seeing a lot of realtors that are stretched right now and own 3, 4, and 5 properties that themselves are not cash flowing. They were hoping to turn a quick profit on these. But yeah, and this article says that some pandemic trends are still in play. The widespread adoption of work from home policies early in the pandemic contribute to the increased competition and price growth in certain markets. I think that's absolutely true. It's a lot more fun to work at home from your own home where you can go out to the garden, take a break, go lift weights in your garage or something like that than it is in a 2-bedroom apartment downtown somewhere, right? If you're working from home, it's better to have more space in your home. So I think that is going to continue. A lot of workers are not going back to an office, right? So I'm going to move on here and answer some questions. And let me see here. Elon Olens, you said you wanted to ask something else, but not to change the subject. When can yeah. Yeah, feel free to ask any questions here. So Mark Butler, I'm gonna talk about your question here. And hold on just a minute. All right. Elon rips phony social justice warriors after Tesla is booted from the S&P ESG Environmental, Social, and Governance Index. So I read a little bit more into that article, at least the one that I saw. And so I've not been the biggest fan of Elon Musk's antics in the last couple of months because it's been affecting my own personal net worth. Getting wild swings in valuation because of it. And I've made this statement before that a lot of Elon bros that approve of everything that he does and basically see him as a new messiah or part of this intellectual dark web, a lot of them don't own Tesla stock and don't own lots of Tesla stock and haven't put a lot of their wealth behind it. They're just fanboys, right? They're not really invested in Tesla. They might own one share or something like that. So when he talks, they might lose $200 or $300, where you and I are losing $200,000 or $300,000 in that case, or in a lot of investors' cases, right? People have been invested in him for a long time. So a lot of what he's doing right now, I feel, is kind of a distraction from his primary job, which is to manage Tesla. Now, the ESG, the Environmental, Social, and Governance Index that Tesla was booted from, I don't know that that's permanent, but he wasn't booted from there because his company wasn't doing things that were environmentally sound. They wasn't doing things about the carbon strategy for the company or anything like that. They were really booted because of the terrible work environment created at Tesla. So I know two people that still work for Tesla directly. Both of them hate their jobs. They're only there for the stock options. You know, that's the only reason that they're there, and they're both planning to leave somewhere else, and they've got better offers, right? In both of these cases, I think that this is kind of the compounding effect. If that Elon keeps affecting the price of the stock for a lot of people that are working there, he's going to lose some of his best talent, as they're going to end up going somewhere else because they have terrible work conditions and that sort of thing too. So I'm a huge fan of Tesla. I have been a huge fan of Elon Musk for many years. Not a big fan of what's going on right now, particularly surrounding the juvenile behavior that he's exhibited around the Twitter purchase. I think they made a spur of the moment decision. He's already violated securities laws a couple of times, like when he acquired, I think, 5% of the company without filing proper paperwork, and then went on to, say he wasn't going to take a seat on the board, and then acquired 9.2% of all the outstanding stock, and then said that he was going to take a seat on the board. All of that without making the proper filings is actually a violation of securities law. Saying that you want to renegotiate the price of the stock or the buyout without properly making the right filings at the SEC, that's a violation of securities regulations or securities law. He may have violated his non-disclosure agreements, all kinds of things. I think that he has serious buyer's remorse. Maybe he's not been able to secure funding for the deal, and he wants to find a way out of it. But just poop emojis in response to the CEO of the company that you're looking to buy out is utterly juvenile. And it's actually hurting the investors in his companies right now. People that have put their faith in him as a responsible CEO. So I realized I'm going to get people who unsubscribe from my channel just for what I think is relatively moderate and measured criticism. But trust me, there are a lot of people out there that are a lot more angry than I am. And there are a lot of people that are scared that his irrational behavior is going to cost them thousands, tens of thousands, hundreds of thousands, millions of dollars. And these people are not millionaires, billionaires, or oligarchs like Elon Musk is. They're just regular Joes, regular Josephines who put their faith in this company and decided to invest a long time ago and have been along for the ride. We're not along for the ride to the loony bin though. All right. So that's as much as I'm going to say about that. So anyway, Tesla have just opened up some superchargers here in the UK to non-Tesla owners, can pay per kilowatt hour or via subscription. So that happened too, and I think they've done that in Holland, and they've done that here in California as well. And I think that's just kind of the wave of the future. And a lot of the folks who are investing in these charging companies like ChargePoint and Blink and a lot of others, I've said this for years now that yeah, charging networks are going to expand, but what you're looking at is a field where there's already a major player, and that is Tesla. They're larger than anyone. You're also looking at destructive competition here, where there's no barrier to entry in the charging arena. This is not any sort of specialized technology that is hard to produce or anything like that. So yeah, I think that Tesla opening up their superchargers in the UK to non-Tesla owners is actually bad news for everyone else in the charging business. So Michael Will says, I was just concerned that Russians would seek to target those factories producing the e-bikes. Yeah, so if you went to watch my video where I talked about the e-bikes being produced by not just one, but two companies in Ukraine that are being used right now with fire teams for in-laws, meaning they've modified them to carry a couple of missiles, the launching tube, and put two men on a motorcycle. This provides them with a great deal of mobility. I don't know how steep you guys are in history and how much you've studied like military history or not, but there used to be something called a dragoon. And this was somebody that looked like they were a cavalryman, but they weren't really trained to fight on horseback, largely because it was beyond the age where cavalry was as effective on the battlefield. Meaning, by the time the gun was introduced, the rifle was introduced rather, cavalry had ceased to be the decisive force on the battlefield. It was a cleanup force, meaning you would chase people down and cut them down from behind after they ran away. So the dragoon became sort of popular then, where it was a mounted force where they'd ride to wherever they needed to be with increased mobility. They'd dismount, fight on lines, fight in lines on foot, right, or as skirmishers. So with these e-bikes, that has sort of revived that role, but with these anti-tank fire teams. It's interesting to see how new technology is allowing these to be reproduced. And I made the point in the video, and I've already gotten like 3 or 4 emails on this, that even the batteries could be turned into an incendiary device. And I got like 3 emails telling me to shut up. I'm giving away some sort of secret. No, I think everyone knows that if you pierce one of the batteries with a nail or something like that, it's going to cause a fire, as we can tell by the number of electric vehicles that have actually caught fire. And the fire is actually super hot, like really, really hot too. So when I say that lithium-ion batteries could be effectively turned into very good incendiary devices, that's not an exaggeration. This creates a really, really hot fire. But yeah, I don't know anything about this company's their manufacturing capabilities, where they're located, how centralized they are. So I don't know that they could be targeted by the Russians as well. I think that's a very interesting thing to think about. So Eric M says, I really don't see a recession in these retail earnings. Consumer demands are shifted from products to services. That is an interesting point. That is something that we covered earlier. Consumers are not spending less money. It's just that the money that they are spending has been shifted to services, right? Buying gift cards so they can go out. They're buying experiences. And the Target earnings kind of really made the point that the pandemic, and especially the pandemic liquidity that people had, the actual money that people had, allowed people to front load some of the actual manufactured goods that they wanted. Like they already bought their washing machine. They already upgraded their couch. They already bought a new bed frame. They already bought their new 60-inch TV. How much more stuff do they need? So they're going out there now and they're going to be spending it on experiences. The real monkey wrench that could be thrown here is at whether or not any of these new COVID variants are going to be just as bad as like Delta or something like that. I really hope they are not. My bar is finally open after being closed for 2 years. It is in full swing. We are having great comedy nights on Wednesday nights. Some really edgy, weird, and great stuff that makes people feel uncomfortable. And that's the kind of humor I like, the kind of humor where you're not sure you want to leave the room or laugh nervously. That's the kind of humor that I like. So, yeah. So do you think that Microsoft will try to renegotiate the Activision Blizzard deal due to market correction? So probably not. Okay. So I actually worked at a regional bank in California when it was bought by a foreign conglomerate, and it was right in the middle of 2008. And this is 2008 affected financials more than anything else. And you saw the bottom drop out of the price of the bank that was acquired, and it took a year for the acquisition to go through, and they still went through with the original offer. There are a lot of contingencies and triggers and all kinds of things that go into these purchase agreements. Like you saw the sort of breakup fee, the $1 billion breakup fee that Elon Musk has with Twitter. But look, I'm telling you, if the deal doesn't go through with Twitter, even if the deal goes through with Twitter, Elon Musk is looking at years of litigation, not just from the SEC, but he's looking at years of litigation for class action lawsuits from probably from shareholders from Twitter and shareholders from Tesla, saying that his market manipulation caused them to lose money. This is going to divide his attention for years to come, unless he quickly comes to a resolution and settles with these parties. And this is one of the things that concerns me about that. Microsoft and Activision are acting like adults. It was probably well understood that there was going to be a correction of some sort, or that there was going to be some discounting of the model based on interest rates rising in the future, and the company has been priced accordingly. So, yeah, I do think that they're probably that. They said they're professionals. That's going to happen. Florian Raby says, "Hey Jason, did you have a chance to add SoFi before the bump?" I didn't look at SoFi today. Was there a big bump today? Or are you talking about the one that happened last week? Yeah, so it's 723 a share. So I added a little bit in the sixes, and that was it. I was focused on adding Upstart and focused on added a bunch of other things, and I already own a bunch of SoFi, and I actually sold some cash secured puts a while back. So I'm going to own more SoFi by the end of the week anyway. And Tom Liu says, I don't know if we need the stupid interest rate hike in the first place. They could have used futures market to spoof all commodities to zero, like oil. Okay, that's an interesting concept here, and that's not one that I'm going to address on this live stream. And to spoof all commodities to zero like they did in April 2020. So that wasn't necessarily done. That was all done in April 27th of 2020 by Panic Tom. And to recreate those situations on all commodities could actually cause liquidity to freeze everywhere. What the Fed is trying to engineer, and what they're going to have a real narrow window to do, is to basically is to have a soft landing for the economy. I'm not sure that's in the cards. I'm really not. So let me see here. And I got an ironic comment today from Leo Wu. Let's talk about that. Let's talk about Xpeng. I haven't looked at Xpeng for a while, but I'm sure it's gotten absolutely hammered. It says Xpeng's the best, and then laughing emojis. Yeah, so Xpeng's been having a hard time. But let's talk about this. Shanghai reported for the entire month of April that there were zero auto sales. Zero. Shanghai's been shut down off and on, mostly shut down for the last 7 months. Zero auto sales mean NIO didn't sell anything, Xpeng didn't sell anything, and Tesla didn't sell anything in their largest markets. So there were sales that went on in China, but not in their largest markets. You're probably looking at 2,000 units moved for Tesla out of Giga Shanghai, under 1,000 moved for Xpeng and NIO in the month to come. I'd be shocked if they had more than that, and that's just as a result of the lockdowns. This may not be over. Like I said, what if these new varieties, and we know that China's vaccine is crap compared to vaccine, or China and Russia's vaccines are, well, I hear Russia's vaccine may not be too bad, but we hear China's vaccine is not really good at all. It only has about 60% effectiveness, and that some of these newer varieties that are coming out, there may be no protection whatsoever. So, yep. Anuj Gupta says, let me take a sip of my coffee here. Thanks for doing this. Can you please discuss the impact of dollar strengthening, especially when the U.S. government has so much debt? Yeah, so dollar strengthening is actually bad when the U.S. government has so much debt, right? The whole point of debt is to pay someone back with inflated dollars, right? So and debt has been the hysteria surrounding debt for the last several years has been absolutely ridiculous. Now is when you get concerned about debt, right? Now we have an enormously high budget. We need debt to fund it, and that debt is going to get more expensive. Vast majority of the debt that we have that we issued in the last 20 years, where we've increased the money supply by X amount of times, I don't know, it's been issued at levels that are below inflation. All right, meaning the interest rate that we're paying on it is below inflation, and we're going to be paying these people back with inflated dollars, right? So we could simply let this roll off. If all else considered, if we had a balanced budget, we could simply let the Fed roll assets off of their balance sheet, and eventually, after 30 years or so, our debt issues are solved. The problem is we don't have any budget discipline, so we're going to have to continue borrowing money, and we're doing this at higher and higher interest rates. I think I just saw a a news article saying that I bonds are going this month for like 9.25% or something like that. That's what they're looking at going. So the whole idea with debt, though, is, let's say it's 2008 and I need to loan out $1 trillion. That's great. I loan out $1 trillion to you, or you let me borrow $1 trillion by going to auction, and you buy $100,000 in 30-year bonds. China buys $1 million in 30-year bonds. Russia buys $1 million or $1 billion in 30-year bonds, or whatever the number is. The interest rate is like 2.2% at that time period, and inflation was like 3% in that time period. So 30 years from now, I'm paying you back in dollars that are worth a lot less than what I borrowed them for. So I mean, that principal is a lot less. So the fact that we have inflation right now, if we had fiscal discipline, this would actually be a huge improvement in our ability to pay those dollars back. So if you look at all of the boomers, right now, especially here in really expensive markets like California, like San Francisco, San Diego, Chicago, New York, who look at you smugly and they're like, man, I bought a house when I was in my 20s and paid it off. Yeah, you bought a house in your 20s in 1973 or something like that. You paid $100,000, $10,000 for your house in 1973. You borrowed $10,000 to do it. Inflation was so high that by 1979, your house was worth $100,000 and your salary had tripled because of inflation. That's why you're able to pay off that $10,000 house or whatever you purchased it for. I look at my grandmother's house on Sullivan's Island, South Carolina, where it was purchased for something like $11,000 in 1958, and it's worth millions today. And it wasn't an act of genius that no one figured that out. It just happened, and inflation really hit that island pretty hard in the 1970s. If we had a balanced budget and we didn't need to go out and borrow, $900 billion a year with new asset sales, this period of inflation could be enormously beneficial, but it will not be. We don't have the courage, the political courage, to go back to the 1990s and have a balanced budget again. I don't think either side of the aisle is willing to do that. So, yeah. Keith X says, lol, people are made out of snowflakes. Okay. I'm not sure who you're referring to, people, but yeah. Muhammad Dahir says, do you own Tesla stock? Yes, I own Tesla stock. And I own what I think is a significant amount of Tesla stock, meaning that every time Elon says something childish, my net worth goes up or down by a couple $100,000. So, hold on here. I got to say, Jepson says Belgium is here. Good vibes. So, were you the one from Antwerp or another part of Belgium? Because I used to live in close to Liège, and so I speak French, and I took Dutch in school, but I don't remember that much of it. Yeah. So here we go. This is a great comment here from Eric M. I recall Poland used horse riders against tanks in World War II. Yes, they did use lancers against tanks in World War II. But very interestingly, and in fact, there's actually writings that are preserved of this. The general that was in charge of Polish cavalry before the war wrote that that the tanks were basically, after World War I, he wrote that horses were not going to be obsolete in World War II, and they were not obsolete in World War II. They were used in logistical supply trains all over the place. But he wrote that lancers were still going to be effective in World War II, and in fact, you had Polish lancers charge German tanks in World War II, and their whole doctrine was to get close enough to throw hand grenades into observation slits. Right? They didn't have the in-law, which you could destroy a tank from 1.5 kilometers away, 2 kilometers away, or the javelin where you're looking at 3 or 4 kilometers away. So yeah. Do you have a plan for withdrawing your profits from Tesla over time? It sounds like if it blew up, it would impact you considerably. Yes, I would be deeply impacted by Tesla blowing up, like deeply impacted. And there's very little about his past behavior that has caused me to be as concerned as he is right now. The problem with this is that he has long believed that the rules don't apply to him, and that's hasn't been too much of a problem until now. Like it started to in 2018 when he threw a fit over being sanctioned by the SEC regarding his tweets with the whole infamous funding secured thing. He has never believed that he was in the wrong. He has said that they are stupid, that the SEC was stupid. And so what he doesn't understand is the SEC is not punishing him to punish him. They are punishing him because he affected the wealth of millions of other shareholders by leaking details of this deal before any agreement was actually made. Right? You simply can't do that. You do that through SEC filings. You can't do things to manipulate the stock price uh, as you're trading a deal. This is securities fraud by definition. When I say that he is under investigation right now, he is under investigation right now. He will be charged with something or slapped down by some regulatory reason. And not only that, there's going to be a class action lawsuit from Twitter shareholders. And I'm talking the big boys who are Twitter shareholders, the brokerage houses, and the backers of this deal also are also going to be involved in lawsuits against them. And as well, a bunch of Tesla users are going to say that your activities on Twitter and your activities with the Twitter deal actually affected share prices. So, yeah, here we go here. Amazon fuel costs. Oh, yes. Yeah. This is a good point. This is a good point. Wait for a second for this comment to come up. Eric M says Amazon fuel costs went from 14.5 billion estimated to 27.3 billion in 2022. That's that's almost doubling the fuel cost in 2022, right? 14 billion or more dollars, 13 billion more dollars. And I think this is absolutely amazing that their costs have risen so much. And this is impacting the bottom line. Like the point you made earlier, we're not seeing recession right now in terms of consumer spending. We're seeing it in terms of company bottom lines because their expenses are getting so much higher. So eventually, most of those expenses are not going to be eaten by the company forever. They're going to be pushed on to the consumer. When they're pushed on to the consumer, and not that they aren't already, we're seeing higher prices on a lot of things, but not on everything. If you look, there was a chart that came out a few weeks ago, and I'm not going to track it down right now, that basically showed where inflation is occurring right now, and it definitely wasn't occurring everywhere. There are certain areas where we're seeing high inflation and certain areas where we're not. As time goes on, you're going to see inflation pretty much in everything. So, and it's not going to be just limited to certain things that are inflation sensitive. So, yeah, I think, and then once those prices are passed on, we're going to see significant impacts with consumer behavior, and I think that is something that I don't like to guarantee things. I think that's something I can guarantee. So Keith X says, I don't know about big box stores, you mean, but business has really been bad for me, right? Retail business sales are down, margins cut. I paid $650 for a freight fee for a $3,000 order, New York or California to New York. So just recently I was, a buddy of mine was trying to buy a boat and ship it. It's a Maycraft, and he's trying to ship it from the East Coast to here. And freight rates have gotten insane. It is now $5,000 to ship a boat that used to cost about $2,400 last year. And I'm looking to ship down materials to start building my next boat because I just finished building a boat. And that's just a hobby of mine. And the freight fees went from roughly $650 to about $2,400 to ship down from Oregon. So yeah, I'm seeing this right now. It surprises me that we're seeing so much impact with domestic shipping, though. I think that's more of and only some of that is going to be due to the increase in fuel prices. A lot of that is going to be basically sympathetic rise in price because we're looking at the impacts in container shipping. That's where we're seeing the most impact right now, and one of the largest sources of inflation. It's not just the fact that we have this huge money supply out there; it's the fact that ships are idled right now. Some ships are idled right now with full cargoes. Some ships can't unload the cargoes they have in China or in order to load new cargoes to leave those waters. There are a number of different apps you can go online and look and see where all of the transponders for different ships are located all around the world. And if you look off the coast of China right now, it looks like a giant cloud because there are so many ships sitting offshore. It looks like it did at the port of Long Beach last year around this time, where there were 25, 30 ships just what I could see on the horizon, just sitting out there at anchor, waiting to go into the port to be unloaded. The same thing is happening right now off, off Chinese ports, like the port of, is it Guangzhou, where it's the Pearl River Valley, where 57 million people live there. It's a major manufacturing center, and it's a freaking parking lot for boats right now. So if you think that supply chain woes are improving, they are not, based on what was happening over the last 7 weeks in China. China is basically the manufacturer for the world. It's the beating heart of global capitalism. And that is a huge concern right now. And there are a couple of ways to see that. And I don't remember exactly how to bring them up. I don't want to keep you waiting here. So Mark Butler says, people keep asking about Joby with Expo. Can you get exposure to flying cars? Actually, that's a really good point. With Xpeng, you can get exposure to flying cars with a lot. I'm going to leave that comment up. So people keep asking about Joby, and there's a gentleman from, it's either Estonia or Latvia. Sorry, I can't remember which one. I know it was either Latvia, Estonia, or Lithuania, and I want to say Estonia. But he keeps asking about Joby, and I'm looking into the technology right now, particularly the noise reduction technology. There was nothing about Joby financially that's out of the ordinary. It's just a company that doesn't make money right now. A lot of the companies we invest in don't make money, and it's going to take years for them to hit profitability. Xpeng is further along the road in terms of profitability. They have a diverse product line. They spend a lot of money on research and development, and they already have real products that they're selling to people. And they've made this pretty large investment into flying car technology, and they already have a couple patents that are out there. And they have the software suite to do it. So I haven't even looked at Joby's software suite. And and so Joby is based here in Southern California. I know that they may be a little bit further along than I think, because they have this gentleman that specializes in nothing but regulatory risk, who heads up an entire department there, which means they're already in negotiations with different areas of government here in the United States to iron out how many of these things, how this is going to work with the Federal Aviation Administration. So, they are arguably further along than some FEV startups. And I would say that not even arguably, I said they are further along than them. And a lot of that has to do with their software. So it's like Tesla free Bitcoin exposure. That's Tesla's going to get wrecked in the next earnings. And their earnings is going to be pretty far. It's going to be a good buying opportunity, as long as we're not watching Elon Musk turn into Howard Hughes here. I think that Tesla's getting wrecked in their next earnings because Giga Shanghai was shut down for 6 weeks, and because we've seen a crash in their Bitcoin holdings. I think that you are tongue-in-cheek kind of correct. You get free Bitcoin exposure, but the decline in price when they report earnings for the next quarter, I think, is a good investment opportunity. I will not add at that point because I already have too much Tesla, right? I don't want any more headaches than I already have. So how far do you think inflation will have to fall before the money comes back in equities, or is this not a major factor? So you have two things working when it comes to that. And so I used to work for a bank brokerage, and a bank brokerage where you handle investments, but you work out of a bank. Like it means that you encounter some of the most conservative investors that are out there. Here's the thing. If you can get 5% in a CD in under 2 years, those people will not put their money in the market no matter what, right? There's a whole class of individuals, and a lot of them that I worked with, I'm sure, are dead by now because this was so long ago, and we haven't had interest rates like this in so long. But there's this whole class of personality out there, individuals out there, just people at the certain age, certain amount of like risk avoidance that they want to take. That if they can get 5% in a 2-year CD, they won't touch the market, right? Why would they? And they're going to get 5% in a CD, which is a taxable investment for the most part, right? You're holding it in a bank account. You're losing 25, 30% of that in taxes, depending on your tax bracket. Plus, 3% to inflation. That's not 3% off the top. That's 3% of what the money would have, the purchase power. So if you borrow $100,000, you're getting $5,000 in interest, and we're in an environment where you have 3% inflation. You're losing 3 out of the 5% to inflation. You're losing 1.5% to taxes, right? If this isn't a taxable account, so you're not really making money, and you're not keeping up with inflation. Inflation is higher than 3% or so. So we're entering into an era where inflation is well over 3%, and I don't even know what you could get on a CD right now because I haven't looked at it, but I don't guarantee you, but it's probably not likely that you can get more than 2.5% on a 2-year CD at this point. And yet people are still going into those 2.5 year CDs. So what's it going to take? I don't know how much inflation would have to fall for people to come back into equities, but it's really about not how much inflation has to fall before people come back into equities. It's how well equities do before they're lured out of CDs, right? So it's been a long time since we've had this balance between people that it's been a long time since we've had people that want balanced portfolios, that want cash, bonds, stocks, and everything in the portfolio. Everyone's been cash and stocks, very little in the way of fixed income. And fixed income over the last year has absolutely gotten crushed, right? But it's going to take a pretty long time to see. Like I said, it's not really going to be how much inflation falls. It's how much equities recover. And that is exactly the wrong thing that these folks are going to do when they invest. If you've bailed out right now and gone into CDs or fixed income or to cash, if you're waiting around for the stock market to get better to get back in, you're going to miss that. So, why does California have such a massive surplus? I grew up in Texas, and Texas is probably one of the most indoctrinated populations on the planet, absolutely convinced of their own superiority to everyone, right? And I've talked to numerous friends back there, and they're convinced that California is broke without realizing that California had like a $30 billion surplus in 2019, $35 billion surplus, $70 billion surplus in 2020, and now have a $97.5 billion surplus. Not only that, they're giving money back. Like last year, if you made under $75,000 for the year for your household, you got like an $1,100 stimulus on top of the federal stimulus, plus another like $600 stimulus if you have like children, right? So, and a lot of the folks who got that didn't have high taxes. Now, my tax bracket is pretty high for state taxes because for two reasons. Number one, I have a number of different businesses. And I have to pay a license fee for each one of those. But it's mostly about how many public companies here are located in California and how many companies have stock compensation plans here in California. So a lot of that is from capital gains, right, over the last couple of years. And a lot of that is because these programs, it's either incentive stock options, restricted stock units, or in a couple of other programs where they're stock award programs. You have to exercise at certain prices, or you have to exercise at certain days, and there are ways to avoid like ordinary income tax and to get capital gains treatment for those. So that's one of the reasons why it's so high. It's because so much of the country's innovation originates here. So many of the highest performing. I don't think people outside of. I don't think people in a certain part of the country realize that basically California, New York, and Washington apply for or basically account for something like half of the market cap for the S&P 500, just those three states. Now, granted, a lot in terms of population, but it's really in terms of like earnings per capita and the amount of innovation that goes on here and the amount of capital that is here and the amount of ideas and things that are recycled here. It's absolutely inflation. So, like somebody distracted me there. It's absolutely amazing how much economic activity goes on here. Like San Diego is not known for its as a technology center, but it actually is, especially in biotech. We have a number of biotechs and chemistry type businesses that have sprung up here in the last like 25, 30 years that have gone public. And it's been a major like biotech and genomic center for quite some time. And certain environments, and this is not a San Francisco like environment. Let's put it that way. Southern California is quite a bit more stodgy and conservative than Northern California is. And yet it's still a giant center of innovation. And you really can't say that about a lot of the places where California had lost like 200,000 people and they went to various states, but they're going to states in some ways that have moribund economies where they're fine right now, but they're not really growing. They're not centers of innovation. They're really service centers for the basically periphery service centers for the core production, or for the centers that are our core production of economic activity here in the U.S. So, and they're leaving because it's cheap. And there are unkind things that people say when folks move from California to those states. But the reality is success drove those people out in the form of like high housing prices. Housing prices are high here because not a lot of land available left to build on. In a lot of cases, government regulation prevents a lot of building. But in many cases here, that's the reason why California has such a massive surplus. Number one, income taxes are pretty high, but they're pretty high, but it's mostly about capital gains. Interesting thing about income taxes here, though, my income taxes are not as high as they could be because of a law that was passed last year, meaning that the state income tax that I'm paying through my business, and now I'm able to pay some of it through my business and deduct it at that level. So when I report it to the federal government, I've already taken the deduction for it from my income, right? And this is, I'm sure this was done because of some of the wealthier folks that left California and went to other states where they have no state income tax. Now they're allowing us to, because the state and local tax deduction for federal taxes was limited by the Trump administration to $10,000. So if you pay more than $10,000 in state and local taxes and fees, then you can't deduct any more than $10,000 off of your taxes. And this is really something that hurts the wealthier states. It really hurts the wealthier states. These are the states that already pay more in income taxes, and now you limited how much they can deduct from their federal taxes, right? So yeah. Anyway, that's just my rant on that. I keep hearing on various podcasts that cybersecurity is a good long-term investment. Do you invest in any companies or ETFs? Actually, that is something I've been thinking about doing lately. And this investing specifically in cybersecurity is not something that I have done as of yet. It's something that I keep looking into, and I keep not doing it. I have a good YouTube friend of mine who was working for a cybersecurity company recently. I just can't think of the name of it off the top of my head, who's consistently encouraged me to look into this more and to do more videos on this. And I'll be honest with you, after being in the IT field for many years before I got into finance, you didn't have a ton of dedicated cybersecurity companies that were out there. And back then, the business wasn't quite as exciting as it is today, and the threats weren't quite as real. You know, something though that I actually think hurts cybersecurity right now is the fact that Russian cyber attacks have basically failed. They were not able to they're not able to effectively cripple Ukrainian internet, and Ukrainians cyber capabilities were supposedly not anywhere near what Russia's were. And so this is something we've heard about for years and years, where I've been waiting now for these cyber attacks on the US, these cyber attacks on our NATO allies, and waiting for Ukrainian cyber attacks, attacks on Ukrainian infrastructure, which simply just didn't happen. So I'm wondering how real that threat is beyond, say, the threat of cyber extortion, which some of these companies that focus and protect you from like cyber extortion and that sort of thing, like maybe those are a great investment. I don't know. I need to take a much longer and deeper look at this industry. I can say that I would have been a lot more interested in cybersecurity as an investment if Russia's cyber attacks had been far more successful. But the reality is they have not. And I have to wonder right now also, and I'm sure a lot of people are wondering, who exactly is Anonymous? And why does Anonymous seem to be doing the bidding of the US government at this time, or NATO and its allies? Is it just because they see this as being justified? Or is it that long ago that long ago the name was basically co-opted and there is no Anonymous, and it doesn't function the way we think it does? Did we completely overestimate Russia's cyber capabilities? Is the threat of cyber attack just less than we thought than it was from Russia? Is it less than we thought that was in general? I don't know. This is all going to take months for me to unravel and to really dig into, probably before I make a video on that. So yeah. JVC 20, will China have a problem with inflation? Yes. Do you guys know about Argentina? Argentina is pretty interesting, right? So Argentina, and this is probably what's going to happen in China. Argentina has an official rate. You go to the bank that's run that's one that's involved with the government, and you want to exchange $1 for Argentine pesos. And I don't know what the exact thing it is, but it's probably 115 pesos to the dollar. But if you go out on the street and try and exchange $1 for pesos there in the unofficial or the black market, it's 1 peso, or it's $1 for 200 pesos, right? And the dollar is much stronger in that respect, largely because the Argentine government has vastly overestimated the strength of their peg and how much their currency is actually floating. So they have limited exchanges that you can do at 115, and then you have to go out and do the rest of those exchanges at 200. And this is as a result of they don't really understand how much inflation is going on in Argentina right now. So inflation has periodically been a severe problem in Argentina. This is one of the countries that when you go and take economics classes, you study. Like, they had some of the largest gold reserves in the world. They were the largest beef exporters in the world just after World War II. One of the wealthiest countries in the world, and it just all got pissed away through unchecked inflation, military coups, fascists being in power, socialists being in power. All of that stuff just sort of ruined the economy over 50 years or so until we get to, I want to say, the 1990s, where we have a series of crashes and the Argentine economy just goes to crap, right? And the currency just goes to crap. So very interestingly, we could see something similar happen with Chinese inflation. They are currency manipulators. They have attempted to use U.S. treasuries to peg their currency to ours to keep their currency artificially weak, right? Because they want their exports to us to be cheaper and cheaper and cheaper, and they want ours to be more expensive. We want the same thing. We do the same thing. We have a target inflation rate of roughly 2 or 3%. I don't know what theirs is, but what we may see develop in China is that two-tiered system where we have an official exchange rate that some purchases are made in, and we have an unofficial exchange rate that is a better reflection of inflation, right? And that's the exchange rate that you get on the street. So it's too early to tell what we're going to see there, but I think that's going to come relatively soon here. And we don't have official exchange rates here in the U.S. It's whatever the market says the exchange rate is. And Frantic Pillow says, number one, buy stocks to avoid losing 6% due to inflation, or lose 20% in stocks. Yeah, that's the conundrum right now. And in fact, with one of my business partners, we were having the conversation about if there is a little bit of money that would come into here, do we buy a property with it, right? Do we hold on to the cash thinking that property prices are going to crash, but then when we go to buy the property, it may be that it costs us that much more to borrow money? Or do we buy a property now knowing that the price is going to fall, but we're going to get a mortgage at 5.3% rather than 7.3% 2 years from now, right? That's kind of the gamble that you have to make. Long term, though, there is no asset class that performs better than stocks do, right? There is no asset class long term. And I'm talking over like 70, 100-year time periods where that's and it's far better than real estate. And I know a lot of real estate investors think that real estate has always been the best investment, but in terms of your total return over a long period of time, I believe it's small cap stocks that are the best investment. And for obvious reasons, you're taking enormous amounts of risk. It's enormously volatile, but over a long enough period, I think you're averaging something like 15%, right? If you're with large cap stocks, you get significantly less volatility, but you're averaging around 10% over that same 70-year time period. I think over the next 30 years or so, we're not going to achieve that 10% annualized return. I think it's going to be less than that because we don't have as much in the way of dividends in there. So let me see here. Xpeng is 30% of my portfolio. I don't have a big portfolio, but I have to start somewhere. That's right. Everyone has to start somewhere. Joby got my attention as they're planning to be an air taxi company and manufacturer. So Xpeng also has the plans to be an air taxi company and manufacturer. And so one other thing about Xpeng is they're actually going to face a lot less in the way of regulation and getting off the ground. Joby being based in the United States, in here in Northern California, they're going to have a lot of issues just navigating all of the regulatory issues with the Federal Aviation Administration, with how their drones communicate. We're going to have to figure out a way to subdivide up, the electromagnetic spectrum here, so people's communications don't interfere. So I do think that Mark might be correct in that Xpeng is a way to get exposure to electric flying in a way that's a little bit less risky than Joby. Xpeng already has a significant amount of factories that are online. They have real sales and real revenues and have a pathway to profitability. I can't say any of those about Joby. I definitely can't say that they have a pathway to profitability at this point. But like I said, I am not done with my research on their technology at this point. So Ben Felix made a recent video on how thematic ETFs are a terrible investment. Um, First of all, I'm a huge fan of Ben Felix. And Ben Felix is usually correct about most things. Thematic ETFs, though, don't have a very long history. So being a terrible investment and thematic investments, and we're thinking really like ARK investments, thematic investments in that grain don't really have a very long history, only about 7 to 10 years or so. So I think the jury's still out on those. And he's not necessarily talking about like sector investments being a benefit, like just having something based on like biotech or something like that. But yeah, I do see how you could make that argument over this time period, but you couldn't have made the same argument last year, meaning that last year, Cathie Wood's investments were the best ETFs you could have bought in the last 5 years, the best fund family you could have bought in the last 5 years. And this year, they're definitely the worst. I will have to say, I made a video on this last year that perfectly explained that that's probably what was going to happen. It still doesn't sort of do away with the thesis that everything is changing about the way we live right now. We are in the midst of a technological revolution, and you and I have no idea what's coming here in the future. And that being invested on the right side of that adoption curve is better than being invested in what did better 10 years ago. And that's when you're investing in ETFs and index funds, you're investing in the things that worked well in the past. And I do plenty of that. About roughly 70% of my investment portfolio is in a really industry standard portfolio that's properly diversified among stocks. I don't hold bonds right now. I just have cash, but I'll be buying bonds here in the future, and that's roughly going to be 70% of my portfolio. And for the other 30%, I own individual stocks that are thematically invested, that are heavily technologically based. I understand that there's lots of volatility in there. I understand that the lows are going to be extremely low and the highs are going to be extremely high, right? So yeah. Hold on a second here. And by the way, I love Ben Felix, man. That guy, uh, it's like I wish I had the following that he had. He makes some great videos, makes some great points, and I think he's got a great research team behind him too. So Anush Gupta says, "What do you think about investing in green energy companies, and which one do you think is good for investments?" So you'd need to be a little bit more clear about green energy companies. You could call Tesla a green energy company because they sell their whole solar power systems. You could call Plug Power a green energy company because of they have this whole hydrogen power thing going, hydrogen fuel cell technology going on. So be a little bit more clear about what you mean with green energy companies. If it's just about power generation, I think that a number of those are going to be pretty good investments in the future. I think that investing in the real black hole here when it comes to the green energy revolution is that most green energy companies can only produce energy when conditions are right to produce energy. So you need a solution to store that energy. I think the best investments in green energy are actually going to be in energy storage. Now, there's going to be a variety of ways in which you invest in energy storage. Some of it's going to be battery technology. Some of it's going to be other things like storing it in the form of gravity, meaning that you use the power that you're generating in the daytime to lift a bunch of water up into a tower, and at nighttime the water feeds whatever water system as well as keeps electricity going at night, right? So it's gravity storage. So there's going to be a number of different solutions we use to store energy that have not been used in the past, right? Sort of like a number of ways to store energy from a vehicle that we didn't use in the past, which is regenerative braking. Right? There was all this energy lost when we braked, and we weren't doing anything with it other than turning it into friction and heat. Well, now with the advent of electric vehicles, we're pumping that back into the batteries, and we're doing that with hybrids as well. those ideas are going to come into fruition when it comes to the supply chain, when it comes to, electric power generation and all that as well. So, no, I think that there's a number of different ways to invest in green energy companies that could be good investments. I'd be looking at energy storage right now. And if I'm looking at energy storage, why would I bet on any single energy storage company? Why would I not invest in the components of energy storage? Lithium miners, cobalt miners, manganese miners, uh, all kinds of other things. There's companies that produce silicon anodes, which is going to become a thing. Companies that produce graphite anodes. This new dry electrode manufacturing process. There are a number of companies working on that. And so hold on a second. Elon says, "What do you think about Plug and the company's future stock price?" Um, I don't have a good opinion of Plug Power for a couple of different reasons. So Plug Power has been around for 22, 23 years now. It's essentially a really long science project. They have never made a profit in 20 something years. They have made money by constantly diluting. It's a company that's run by MBAs instead of engineers, and they tend to lack vision. And they had a great early contract with Amazon. They weren't able to really exploit that into a greater role. You have entire countries that are pivoting, like Japan is really pivoting hard towards hydrogen and fuel cell technology, and they have a different philosophy as far as their energy generating capacities because of where they're located, where they have to get their oil from, and the threat of China. They have a very different way of securing an energy future for Japan, and hydrogen is going to play a larger part there than it is probably in the rest of the world. And then let's see, France and Norway also have projects to bring hydrogen into maritime shipping. And France has a plan with Renault to have hydrogen vehicles. So other than a small deal, $1 billion deal that they signed with France, Plug Power has pretty much missed out on all the rest of those centers of hydrogen and fuel cell technology building. Now, I was a huge fan of hydrogen and fuel cell technology 20 years ago when I first learned about it. When I first learned about it, it was already 20 years old. But I've come to the opinion that the real window for change when it came to hydrogen and fuel cell technology was probably 1973, 1974. That would have been the best time to switch over to that. The time has passed, right? We're much more concerned with the overall with overall carbon production in the atmosphere right now. There really isn't a way to scale enough green hydrogen production right now in a way that's going to be more efficient than using the existing electrical infrastructure that we have today to just have a battery electric economy, right? That we have energy storage everywhere. So do I see a future for hydrogen and fuel cell technology? I do, primarily with maritime shipping and maybe with trains, right? Things where you can have where you can pull large objects, you know exactly where you're going to need to refill, and you have battery electric backup, right? We're probably going to see an era here pretty soon where ships coming into port are going to need to be running on batteries, right? The ports are going to just ban them from using their dirty diesel engines. And I think to get around that, we're probably going to see hydrogen powered, container ships with battery backups here in a bit. So, yeah. Hold on a second here. Some things Ben gets wrong. He believes in the dividend irrelevance theory, which is not even worth it to try and beat the market. Actually, that's not exactly what he is saying. He's saying that dividends are irrelevant, and what you should be considering is total return, right? And I agree with that. When any portfolio, there's an element of the dividends that you collect and the element of capital gain, and you have tax advantages with both of those. And that's the thing he didn't address in that video in dividend irrelevance is the tax advantages of having a portfolio made up of dividend pairs that pay qualified dividends, in which you could pay 0, 5, or 15% in the way of taxes. Whereas if you have and you have low turnover in that portfolio, and when you do need to sell or have or something like that, your total return is a mixture of capital gain and qualified dividend. So it's not entirely irrelevant in considering your tax bracket, right? But no, he's not saying that they're completely irrelevant. He's saying that the thing you should be focused on is total return and not and that's how you try and beat the market, is through total return, not just by using dividends. So there's a number of different like dividend anomalies, like the dogs of the Dow theory, that's supposed to beat the market over time. And investing in dividend growth funds, you're going to beat the market over time. Those are yet to be conclusively proven. I can definitely point to certain periods where buying based on a dividend growth model is going to beat out the market over time. And there are investors like Warren Buffett who that's how they invest. But I can't definitively look at different slices of the market and say this is always true. It's always going to beat the market. So yeah. Actually, yes. So STEM is actually the company that I was thinking about and looking into today. And so I was looking into STEM today, and that's really the big hole when it comes to switching over to sustainable energy, is energy storage. I think energy management software, I think that energy storage systems may actually be the biggest winner in this. STEM seems like it'd be a great investment, but I think maybe investing in the companies that provide STEM the components they need for energy storage may actually be even better than that. So Brian Lee says, I regretted selling my SoFi last week. Good thing is I didn't sell them all. Anyway, I made some money off Microsoft, but no way what I would have missed out on SoFi. Yeah, that's always a problem. It's always a problem with anything. It's I recently had to sell a couple of things for unrelated reasons, and I regretted doing it just because I can sit on things for a very long time and not have to do anything because everything else in my life is like kind of taken care of, right? It's like I don't live high on the hog, but I don't usually need the money that's invested. And here's the thing with investing. Anytime I buy a mutual fund or now ETF, sorry, index, I never think about it again. I don't think about whether it's a good decision. I don't think about whether it's a bad decision. I get $100 here, then 50 of that's going into my, now roughly 50% of that's going into my ETF portfolio, and 50% of that, or 30% of that, is going into individual stocks, and the rest of that's going to cash, right? So just for right now. And typically that's the way it works. Those percentages get mixed around a little bit, but I never think about what goes into those index ETFs. I never think about it ever again, ever, not once, right? And I won't think about it until I'm 75 years old and I'm forced to take monies out of those because of required minimum distribution, or I'm ready to start spoiling the crap out of my grandchildren or great grandchildren, right? But whenever you buy an individual stock or individual investment, at almost any point rather, you're going to look back one day and you're going to say, man, this was kind of a mistake. I wish I'd have bought it at this price. Or you're going to look at it and say, oh man, I wish I'd sold it at this price and got back. And it's very human to do that at all times. It's also completely useless, especially in the short term, utterly and completely useless. And I do this too. There's no cure for it as far as I know, but typically that's why I say I've got a minimum 5-year time horizon anytime I buy anything, just because by the time you've gotten out to 5 years, the chances that you will have lost money on an investment are actually fairly low. If you buy virtually anything over 5 years, you have about an 80% chance of being up on that investment unless the company completely goes under. But if you're trading, the more frequently you trade in that first 5 years, every time you trade, the chance that you make a mistake and end up with less in return than simply holding the investment goes up every single time you make a trade. That's the reason why that buy and hold investing has outperformed. It's just because you're taking many, many fewer chances of making a mistake if you simply have a time horizon and you stick with it, right? So yeah. Here we go. What do you think of Tesla being paid out in dividend, and what's 100% it'll be approved. So the Tesla special dividend, stock dividend being paid out, it is not a stock dividend. It is absolutely just a stock split. And there are a couple of reasons why they could be doing this at this time, but I think in August they're going to vote on that. It is a foregone conclusion. It is absolutely going to happen. There's zero chance that investors would not approve this happening, because investors are largely convinced that every time there's a stock split, the market is always going to respond by rewarding the company that split the stock. That is only true to an extent. And after a certain amount of time, that stops working. Okay. So yeah, so that's so zero chance that it won't get approved. Absolutely zero. Anuj Gupta says power generation company with natural sources. You see, I think that's a tougher play to invest in. Like if you're looking at investing in a hydroelectric company, most of those are in part owned by the state, meaning some sort they have government involvement. If you're looking at doing something like geothermal, once again, most of those are going to be involved somewhere in the state. If you're looking at solar projects have a really long turnaround time in yeah. Hold on a second. Let's see here. Sebastian says, "Hey, I took a position in an agricultural stock you mentioned a while back when the war kicked off. LSB Industries has held up relative to what you look on agriculture." So I'm not sure that I actually mentioned that particular stock. I don't think in that program that I actually mentioned stocks. I just said that wheat would be a good way to go. Fertilizer and potash producers would be a really good way to go. I do think that if there is anything going wrong with those investments right now, it's just a reflection of the macro economy. And I think that relatively quickly you're going to see that wheat futures are going to get quite a bit more expensive. Corn futures are going to get more expensive. We can see replacements for wheat start to get more expensive, uh, like sorghum and teff and all kinds of other things. You're going to see the price of beer get higher in the United States here. So you're going to see that worldwide. And I do think that potash producers are probably going to be one of the biggest winners out there. And I never did go up and look at that stock that I used to be so involved with years ago. That was one of the biggest potash producers. But the United States is going to produce a lot of fertilizer this year, and so we've been outcompeted by Russia when it comes to producing fertilizer for quite some time. Um, and I think that once we get back on that bandwagon of producing nitrates for fertilizer, we may not get back off of it. This may be a permanent reshoring of that option, right? Because one of the problems with fertilizers is that basically fertilizer in bulk had largely been bought and accounted for like a year, 2 years in advance. And there wasn't a huge spot market for like a new player to get in the business. So like right now, we want to plant, let's say, just for an example, we want to plant 1 million extra wheat or acres of wheat this year. So we can grow 1 million extra acres of wheat, but we don't have the fertilizer to make it really produce. So it's probably going to be about 25% less productive than it would be if we had all the fertilizer we needed, right? So that's one of the things that's going to happen. So let me see here. Intrepid potash ran pretty high, but has been leveling off with this market dip. Don't worry, it's coming back. So Russia was one of the largest exporters of nitrates, one of the largest exporters of potash, and those and so was Ukraine, and we're going to see those levels drop off rather dramatically here in the future. So I wouldn't worry about it right now. If you're selling, if you're buying wheat futures right now, there is an ETF. This is not a recommendation to buy or sell, of course, but there is an ETF called or the ticker symbol is WEAT, and it is a wheat futures ETF. You may want to take a look at that, right? And if you own 100 shares of that, you can buy and sell options on top of that too to generate income, just in case it's dead money. All right. So Brookfield Energy for energy storage. I have not looked at Brookfield Energy in quite some time, so I don't have an educated opinion on them anymore. So let me take a look here. Look at what Koifin has, kind of the top charts here. If you guys don't know about Koifin, this service, as far as I know, is completely free. You do have to sign up for it, so you have to give them your email address and all that. But they haven't. I keep waiting for them to charge me for all of this stuff. But yeah, just back to agriculture for a minute, though. I do know that that talks are already underway to have farmers plant a lot more. We pay for farmers to idle a lot of fields, and they do it on their own anyway for just as good agricultural practice. But we pay them to idle fields to control markets. So I know that with corn farmers, they've already put a lot of that back into production. With wheat farmers, we're probably going to see Canada be a big beneficiary of wheat prices. And let me see here. Generally, tips. Okay, so I'm looking at fixed income here. Tips again on the rise. U.S. Treasuries. Oh, U.S. Treasuries are finally up. Interesting that municipals have actually been getting crushed lately as well. If we're looking at high yield, you guys know what high yield bonds are? It's what we used to call this is corporate investment So corporate ETFs since November of 2021 have declined significantly, and I don't pay as much attention to the fixed income market than I used to. But this is going to be very interesting. The spread between high yield bonds and U.S. Treasuries is very important. We've seen high yield bonds, which are just junk bonds. These are bonds of less than stellar credit quality, less than investment grade. So this index here has gone from a high of around 85 down to 76 here. And at the same time, we've seen the yield on like 2-year treasuries increase. As that spread increases, it's a greater and greater indication of problems in the economy and a greater indication that we're heading towards a recession. So, yeah. Anyway, folks, it has been about an hour and a half now. My voice is actually starting to hurt a little bit, and I need to do a few things before I go into the academy tonight to teach classes. It's always great to hear from you guys. Had a few more people on the live stream today. Stay calm, just breathe. Even the market being down 1,000 points is not the end of the world. We've been talking about this for more than 2 weeks now. It's one of the reasons I've been doing live shows day after day, is because I know that we're not done with volatility. We had a couple of good days. Those good days were just wiped out by this bad day. We might have good days tomorrow. I don't know. But really, the rest of the week is just going to be filled with bad news in terms of the retail sector. So the main concern that I have right now personally is Tesla and whether or not Elon Musk is turning into, thank you so much, Hawk. Hawk, you actually gave me a $10 super sticker yesterday, and thank you so much. I really do appreciate it. It's not necessary that every time you're on here, you guys do super stickers, but I really, really do appreciate it. So thank you so much. I'm sorry for never giving you guys warning when I do a live stream, but to be honest, I never know until about an hour and a half beforehand when I'm going to do it. So I'll try to do them for as long as this volatility lasts. I'm going to try to do them almost every day, except for Fridays. I'm going to take the day off and go fishing or something. Anyway, folks, very nice to hear from you again. I look forward to talking about anything it is that you want to talk to. Feel free to ask me any questions about the geopolitical environment and how that's affecting us economically, and about individual stocks, future trends in technology, that sort of thing. Love to hear from you guys. Feel free to comment. Let me know what you think in the comments below. Leave a comment on the video too afterwards. It helps it with the algorithm. And if you haven't subscribed, please subscribe. Thank you very much.